Let me tell you about a guy named Derek. Derek is 34 years old. He lives in Austin, Texas. About 2 years ago, he put $15,000 into Rocket Lab. When the stock was sitting around $20 a share, he watched that position climb to over $130 a share. On paper, he turned $15,000 into almost $100,000. He feels like a genius. But Derek has no idea what is about to happen because the biggest IPO in the history of the stock market is days away. And when it lands, the money that pumped up stocks like his has to come from somewhere. By the end of this video, you are going to know exactly which space stocks are built to survive the SpaceX listing, which ones could get crushed by it, and the 3-stage game plan that I am personally using to position around this entire event. And there is one company making nearly $500 million a year in real profit that almost nobody is talking about. That is the one I want to start with. But first, you need to see what happened the last time a giant went public. Quick note before we go any further. I am not a financial advisor. Everything in this video is for educational purposes only. For your specific situation, always check with a qualified professional. Here are the facts. SpaceX filed its S-1 on May 20th, 2026. The ticker will be SPCX on the NASDAQ. The roadshow starts the week of June 8th. Pricing is expected around June 11th, and trading could begin as early as June 12th. The target valuation is around $1.75 trillion. They are aiming to raise up to $75 billion. To put that in perspective, the previous record for an IPO was Saudi Aramco at $29.4 billion. SpaceX is trying to raise more than double that. Goldman Sachs is leading 21 underwriters. And here's the detail that changes everything for regular investors. 30% of the float is set aside for retail. That means you and me can buy shares through Schwab, Fidelity, and Robinhood on day one. SpaceX is not a small startup hoping to make it. They command 82% of the global commercial launch market. Last year, they put up $18.7 billion in revenue. Starlink alone brought in $11.4 billion with $4.4 billion in operating income and over 10 million subscribers. The space economy itself is worth $626 billion today. The World Economic Forum projects it will hit $1.8 trillion by 2035. So the opportunity is real. But here's the part most people are not thinking about. When this much money rushes toward one stock, it has to come from somewhere. And the stocks it comes from are the ones most investors are sitting in right now. Because what is about to happen with SpaceX? We've actually seen this movie before, and the ending was not pretty for the stocks everyone was holding. We have seen this before. Let me take you back to May 18th, 2012. Facebook goes public. It was the most anticipated IPO of that era. Everyone knew it was coming, and there was a company called Zynga. If you remember Farmville, that was Zynga. They generated roughly 10% of Facebook's total revenue. Investors had been buying Zynga as a way to get exposure to the social media wave before Facebook itself was available. Zynga was the proxy, the substitute. And here's what happened the moment Facebook went live. Zynga crashed 11.4% in 8 minutes. 8 minutes! The drop was so fast it triggered NASDAQ circuit breakers. By the end of that day, Zynga closed down 13.4%. But it was not just Zynga. Yelp dropped 12%. LinkedIn fell almost 6%. Every company that investors had been using as a stand-in for Facebook got hit the moment the real thing showed up. This is called capital rotation. The money that was parked in substitutes moved into the actual company that everyone wanted all along. Now fast forward to today. The space stock versions of Zynga are Rocket Lab, AST SpaceMobile, and Redwire. These are the stocks investors have been buying as a way to get space exposure because SpaceX was private, and the rotation has already started. In late May 2026, SpaceX trimmed its valuation target from $2 trillion down to $1.8 trillion. That wasn't even bad news. It was just an adjustment. But the Procure Space ETF dropped almost 11% in 2 sessions. Rocket Lab, Intuitive Machines, and AST SpaceMobile fell 17 to 23% on a single headline. The IPO hasn't even happened yet. So here's the question that actually matters. If the proxy stocks are going to get hit, is there any way to play the space race that doesn't depend on SpaceX? There is. And it goes back to an investing idea that's over 175 years old. It's called picks and shovels. And the company I'm about to show you has used this exact playbook to print a profit every single year for over 2 decades. The $500 million profit machine. During the California gold rush, most miners went broke. They spent everything they had chasing gold that may or may not have been there. But there was another group of people who got rich every single time. The people who sold the miners their picks and their shovels. They didn't care who found gold. They made money because people kept digging. That's exactly what CACI International does for the space race. Most people know CACI as a government technology and intelligence contractor, the company that builds cybersecurity systems and data platforms for the federal government and the Pentagon. But CACI has quietly turned into a real space company, and the numbers behind it are staggering. Fiscal year 2025. Revenue, $8.6 billion. Net income, $500 million. That's nearly $500 million in profit in a single year. EBITDA came in at $966.8 billion. And here's the part that really separates CACI from everything else in this basket. The company has been profitable every single year for over 2 decades. Not most years, every year. But the number that grabbed me even more than the profit is the backlog. As of December 31st, 2025, CACI has $32.8 billion in signed contracts waiting to be fulfilled. That's nearly 4 years of revenue that's already locked in before they win a single new deal. Now, let me tell you what made CACI a space company. In March 2026, CACI closed its $2.64 billion acquisition of a business called ARCA. ARCA builds the electro-optical and infrared sensors that fly on satellites. They also build laser communications terminals, a product called Crossbeam that lets satellites talk to each other in space. Crossbeam actually won an Edison Award. About 90% of ARCA's revenue comes from national security programs. This plugs CACI directly into the Golden Dome Missile Defense Initiative and every major satellite constellation being built right now. The framework that matters. CACI makes money every time a satellite goes up. It doesn't matter whose rocket carries it. SpaceX launches it, CACI wins. Rocket Lab launches it, CACI wins. Some brand new company launches it 5 years from now, CACI still wins. That's what picks and shovels means. And the valuation is reasonable. The stock trades around $525 a share with a price-to-earnings ratio of about 21. For context, Rocket Lab trades at 91 times sales, not earnings, sales. CACI doesn't pay a dividend. It returns cash to shareholders through buybacks instead. Here's the myth. You need to buy a rocket company to profit from the space race. Here's the truth. The most reliable money in space goes to the companies that build what every rocket carries, not the rocket itself. Now, there's a second picks and shovels name that several YouTubers have been talking about, and I need to clear something up because a lot of people are getting this one wrong. And I mean factually wrong. The stock everyone is getting wrong. You may have seen videos talking about Cayman Holdings as a space and defense play. They mention the ticker KAMN. They talk about missile parts, rocket motor nozzles, and components for the Patriot and Javelin. Here is the problem. Cayman Corporation was taken private. In April 2024, a firm called Arcline Investment Management bought the entire company for $1.8 billion at $46 a share. Cayman does not trade on the stock market anymore. You cannot buy it. The company that actually makes solid rocket motor nozzles, payload fairings, and missile components for the military is a completely different business. It is called Karman Space and Defense. The ticker is KRMN. Karman completed its own IPO in February 2025, raising $581 million. Similar names, totally different companies. And Karman is a legitimate picks and shovels business. Fiscal year 2025 revenue, $471.5 million, up 36.6%. Adjusted EBITDA $143.3 million with a 30.8% margin. Backlog crossed $1 billion by March 2026. The Department of Defense gave them $5 million in Defense Production Act funding to expand their nozzle manufacturing capacity, and they raised 2026 revenue guidance to $715 to $730 million. Now here is where I have to be honest with you. The business is strong, the growth is real, but the valuation is extreme. Karman trades at roughly 237 to 285 times earnings, depending on how you measure it. The stock has also fallen over 45% from its March 2026 high of around $102, down to roughly $54 in June. Part of that drop came because the private equity sponsor exited through a secondary offering at $61. When insiders sell that aggressively, it tells you something about where they think the price is headed short term. So Karman is on my watch list. It is not in my buy zone yet. The business earns its place there. The price does not. Not today. Before I walk you through the names I think are at most risk, drop a comment right now. Are you holding any space stocks heading into the SpaceX IPO, or are you waiting on the sidelines? I read every single comment, and I am genuinely curious how you are positioning for this. Now, let me walk you through the 3 stocks that carry the most rotation risk heading into the SpaceX listing. And I want to be clear, these are not bad companies. They are real businesses solving real problems, but they are priced as if everything goes right at the exact moment the biggest competitor in their industry is about to go public. Rocket Lab, ticker RKLB. This is the closest public proxy to SpaceX. They build and launch their own rockets with Electron, and they have a bigger rocket on the way called Neutron. Revenue hit $200.3 million in Q1 2026 alone, up 63.5%. Backlog is $2.2 billion, but the company still loses money. Net loss of $45 million last quarter. They filed a $3 billion shelf offering, which gives management the ability to sell shares over time. That is real dilution hanging over the stock. The market cap sits around $49 billion at roughly $124 a share. That works out to about 91 times sales. And here is the core problem. Rocket Lab directly competes with SpaceX in launch. The moment investors can buy the actual market leader at a comparable valuation, the question becomes, why hold the number 2 at 91 times sales? AST SpaceMobile, ticker ASTS. This is the boldest swing in the entire space sector. They're building satellites that beam regular cell signals straight to the phone already in your pocket. No special hardware needed. The FCC approved their full 248 satellite network in April 2026. They have $3.5 billion in cash and over $1.2 billion in contracted revenue, but actual revenue for all of 2025 was only $70.9 million. Net losses were $342 million. And here is the double bind that makes AST the riskiest name on this list. AST competes directly with SpaceX's direct-to-cell service. SpaceX literally named AST as a competitor in their S-1 filing, and AST depends on SpaceX rockets to launch its own satellites. It competes with SpaceX and relies on SpaceX at the same time. The stock trades at roughly 260 times estimated 2026 sales. Redwire, ticker RWD. They build solar arrays, avionics, docking hardware for satellites and space stations. Last year, they spent $925 million to acquire a company called Edge Autonomy, which makes combat drones. But most of that price was paid in stock, which means existing shareholders got diluted. Revenue was $335.4 million with heavy net losses. And here is the analyst call that everyone should read. Jefferies downgraded Redwire to a hold on June 1, 2026. Their exact reasoning was that the stock's gains reflected SpaceX IPO excitement rather than actual financial performance. When an analyst at a major bank tells you the price is built on hype, not earnings, that's a flashing yellow light. Here is the line I want you to to remember. The space race is real, the profits are real, but if you're buying the hype instead of the business, you are the one funding someone else's rocket. So now you see the full picture. Who wins, who is at risk, and why. But knowing is not enough. You need a plan. So let me walk you through the exact 3-stage playbook I'm using to position around this IPO.
My 3-stage game plan. Stage 1, before the IPO. That is right now through roughly June 12th. This is where I favor the profitable picks and shuttles names for core space exposure. CACI is the cleanest position I see. Real profits, reasonable valuation, nearly 4 years of backlog, and completely insulated from the SpaceX rotation because it does not compete with SpaceX. It supplies the entire space ecosystem. During this stage, I am cautious about adding to positions in Rocket Lab, AST, or Redwire at current multiples. If you already own them and they have run up significantly, this is the time to consider trimming into the strength before the listing pulls capital away. Stage 2, at and just after the IPO. That covers roughly June 12th through November 2026. My biggest rule here is this: do not buy SpaceX on day one at a 20 to 40% pop. High-profile tech IPOs frequently retrace within 90 days. The first public earnings report for SpaceX is expected around November 2026, and the 180-day insider lockup expires around mid-December 2026. Both of those events historically pressure newly public companies. I would rather wait and buy at a fair price than chase the excitement on day one. But here's the other side of that coin. If the pure play space stocks sell off sharply on rotation and not on bad fundamentals, that is where opportunity starts to show up. Rocket Lab at a significantly lower price with a successful Neutron launch would be a completely different conversation than Rocket Lab at 91 times sales today. The benchmarks that change the thesis. This is where I stay flexible. I get more bullish on the pure plays if Neutron's first launch succeeds, if AST hits 45 satellites and books real commercial revenue, or if the SpaceX listing actually lifts the entire sector instead of draining it. I get more cautious if the pure play multiples stay above 100 times sales without a profit, if dilution keeps accelerating, or if SpaceX gets added to a major index and forces funds to sell smaller space names to make room. The bottom line is this: the space race is a once-in-a-generation opportunity. $626 billion today, $1.8 trillion by 2035. But opportunities only pay off when you have a plan. The crowd is going to rush into SpaceX on day one and get shaken out when the price pulls back. The smart play is to own the businesses that win no matter what, and then use the volatility that everyone else panics about to build positions at prices that actually make sense. If someone you know is holding space stocks and does not have a plan for this IPO, send them this video right now. It could save them from a very expensive surprise. What is the one space stock you are most worried about heading into the listing? Drop it in the comments. I want to see what you were thinking. And if you want to stay ahead of market-moving events like this and know how the money is actually flowing, subscribe to this channel. I break down every move that matters. Next week, I am diving into what happens after SpaceX lists, the second wave plays that nobody is positioning for yet. You're not going to want to miss that one.